In this video series, we are going to learn about the basics of markets. I'm pretty sure that most of you would have come across the term stock markets, the stock exchange, the National Stock Exchange, Bombay Stock Exchange, and you would have actually come across pictures like this building, and definitely you would have seen this building. And most of the news channels on a daily basis, they report pictures of people staring outside of this particular building, looking at tickers that is actually scrolling. So today we are going to learn more about that, some common questions that you could actually have regarding the markets, and we are going to clarify each one of them one by one. First and foremost question that one could have is, what is the purpose of a stock exchange and what happens out there? In very simple words, I could explain. A stock exchange is nothing else but a meeting place for buyers and sellers of shares. That is, people who are looking forward to purchase shares and people who are looking forward to sell shares, they meet at this particular common place called as the stock exchange. So B stands for buyers and S stands for sellers. Now, if you have a question, why do we need a stock exchange for the first place? And rather, for example, if you wanted to kind of purchase some vegetables or something, you go into any vegetable shop. Similarly, like you probably would be thinking, okay, I have 10 shares of Reliance. Now I want to sell it to somebody else. Why can't I directly hand it over to someone else who is looking forward to buy it? Just like we exchange second hand things called on OLX, things like that. Same way, the reason why we have the stock exchange in first place is because of the fact that we need to make all transactions regulated. So if you are paying someone money to purchase shares, you need to ensure that you are getting those shares that you have paid for. Same way, if somebody else is actually selling some shares, he or she needs to ensure for whatever shares he is transacting, he is receiving back the payment for whatever he has sold. You must have actually come across many scams that you probably would have heard about OLX, where you kind of actually transfer the product but then you don't receive the payment, or you pay the payment but then you don't receive the product. But the stock exchange is a completely regulated place where the buyers and sellers can assure for themselves that they are going to get the transaction completed. Majority of the times we refer the stock exchange to be acting something like an economic barometer. It conveys to us what is the present situation or what is the outlook of the investors and traders in the markets, and any minute changes in the stock prices are also being accounted in. So in simple words, we could say stock markets or the stock exchange is nothing else but the reflection of the economy of any particular country. So we realize for ourselves that the stock markets are more about supply and demand, and definitely the process helps in determining the valuation of different companies and the values of different stocks too. Now let me just give you an example that a company has a good profitability and it has a good potential to grow further. Then definitely the demand for that particular company is going to be high, and naturally the pricing would also be on the other side, on the higher side. Now, we as an individual definitely has a scope for speculation in these kind of markets if we personally feel a good potential in the stock. One of the major important aspects of the stock markets is that it provides a venue for investments and savings. In the long run, we observe it is always the stock market that actually outperforms the general FD interest rates. And another important factor is that just because of the fact that we have the stock exchanges in place, it provides liquidity. That is, it provides an easy venue for you to enter and invest in equities, and at any later point of time, if you wish, you can always liquidate your positions and come out. Now, as far as the companies are concerned, so let's say that a company A is doing really well, then definitely the shares of those companies are also going to be actively traded at the exchange. Now, at a later point of time, if the company A is looking forward to raise fresh funds, they could even consider listing more shares on the exchange that they haven't listed earlier, and the new funds can also be utilized for their business expansion purposes, or it could even be for the founders or the initial promoters to take out an exit. The fourth and the next major point that we personally consider is nothing lesser than the transactional safety that exchanges offer. So every time a buy or sell of equities are happening, the exchange ensures that the transactions are always fulfilled. So as compared to earlier days, right now the exchanges are providing a wide variety of opportunities for the public to invest in. So as compared to the earlier opportunities that we had, which were none other than just the FDs, right now we have many other avenues of investment possibilities. Only thing we need to do is we need to just assess the risk and figure out if it suits our convenience and then go ahead and invest in it. Now basically we have understood the major importance of why we have the stock exchanges in place. Now I'm pretty sure that you probably would have come across the term stock markets too. Then what do you be referred to as the stock markets? Okay, so collectively speaking, a collection of stock exchanges is what we generally convey as the stock markets of the world. And when we speak specifically about India, we have the two major stock exchanges out over here, which we refer to as the National Stock Exchange and the other one, the Bombay Stock Exchange. Now talking about the exchanges, obviously the Bombay Stock Exchange, as all of you know, is the older one. The Bombay Stock Exchange was founded in the year 1875 with over 5,400 companies listed on it, whereas the National Stock Exchange is a comparatively newer one. The National Stock Exchange was established in the year 1992 and has around 1,950 companies listed on the same. Now, let's get a bit more deeper into the two companies. Now, you must have actually come across the term both Nifty and Sensex. So, let's understand these two terms a bit more further. So, Nifty is nothing else but National Stock Exchange, whereas Sensex is the index of the Bombay Stock Exchange. Now, some of you would be wondering what do we mean by an index. So, let's understand this concept a bit more further with an example. Now, let's assume a classroom, and if there is a teacher who is asked the question, how is the performance of the class? Do you kind of actually think the teacher is going to spell out the marks of each and every student? The answer is no. The teacher would be able to convey the performance of the class based on the average. He or she would be basically taking into consideration the average of the marks scored by all the students, and they would be saying, okay, this is the average performance of the class. So definitely we know that above 80, the average is kind of considered good. So if all the students have actually kind of scored on average above 80, then definitely the performance of the class is considered to be pretty much good. So same way, when it kind of comes to the index, we need a benchmark to evaluate the performance of multiple companies. So spelling out or mentioning the individual performance of each and every company is very difficult, and tracking all the companies together at any single point of time is difficult. Howsoever, if we have a benchmark or what we refer to as an index, it helps in tracking the overall performance of the markets at any particular point of time. So let's say that the index is actually up today. So it conveys to us almost majority of the companies or the major weights would be doing really well. So that could be the factor that is actually driving index in a bullish sentiment. Now on the other hand side, if we see, okay, the index is actually bearish or really negative, so we get a sense of understanding that almost majority of the companies would be underperforming or would be performing in a bad manner that particular day, or they would be in the negatives. So that is what is actually kind of translating towards making the index negative. So let's understand how the index is calculated.